20%. Andrew.
Okay, joining us right now to talk about the markets and to explain perhaps the best way that investors should be looking at individual companies right now is Greg Branch, partner at 1847 Financial. Good morning to you, Greg. We're all trying to make some sense of this. You're watching the markets under pressure this morning, and as Becky said, you could ascribe so very many reasons for that. That could be the COVID outbreak that we're seeing both here in the United States and abroad. It could be oil prices, which, of course, are correlated to that to some degree. It could be the elections. Right. What do you think and what do you do about it right now?
Well, I think the same factors are still driving as we talked about last time I was on your show, and that is in the short term, the market's going to pay attention to where we are with stimulus, where we are with the election, and where we are with the vaccine and therapeutics. And so as we look at these earnings coming up this week and throughout the third quarter, what will be more important than the actual number is the guidance. And we saw that this morning with SAP. And so it brought the market down because it suggested that businesses were putting off spending a year or two from where they thought they would spend and the amounts they thought they would spend. And so the earnings reports will be particularly important insofar as they give us a view into what 2021 looks. Obviously, the fourth quarter will be important, but we'll soon be past these catalysts, these potentially negative catalysts that we've been talking about, and we'll start to focus on 2021 earnings. And what we can get in terms of information or insight from these earnings reports will be critically important.
You've said there is no lasting tailwind to this recovery. What do you mean by that?
So what I specifically said is we should look for companies that don't have a structural lasting tailwind. When I go to parse my portfolio, or when I go to parse my clients' portfolios, what I'm looking for into 2021 is those that gained a structural advantage versus those that will return to a baseline of 2019 or maybe even lower. And so lots of companies were positioned to succeed in the work-from-home environment, but was that lasting? That's the question we have to ask ourselves, and do they deserve the multiple that they're currently trading at? And so there's no shortage of companies that when we return to a new normal won't be able to put up the results that they put up this year, while others, like the e-retailers, experienced a structural shift, a structural tailwind that will allow them to put up 100% plus earnings growth over the next couple of years. And that's what we're looking for to support outsize.
Tell me how you're going to decipher the difference. Tell me how you're going to decipher the difference, because some people would argue that the e-retailers, I don't know if they would go back to where they were in 2019, but that if the world were to go to any kind of post-pandemic hopeful sense of normalcy, people might go back to brick and mortar shops occasionally. And the same might be said of a Zoom or some of the big tech companies that have had a lot of success during this period. Sure, their success has been accelerated during this period, but what happens afterwards?
Right, and I think you're right. This is the task. There are some that are easier than others to pinpoint and say, well, we might not be spending as much as paint when we're not stuck at home, or we might not be spending as much on flooring. So there are certain easy ones to decipher, and then there are harder ones. When you talk about the e-retailers, they were growing their penetration at 1% per year. In December of 2019, we saw that penetration at 19%. Now it's close to 30%. And just 7 months later, with something that had been growing at only 1% per year. So you're probably right. Not all of that may be lasting, but what we have to do as investors and prognosticators is pick out things that we don't think will revert to an as-is form before we saw the structural change.
I mean, but what about what might be described, I don't even know if you call them value plays, but some of the cyclicals, some of the underloved companies that have been just crushed during this period. I'm even thinking, frankly, of the airlines, which are about as unloved as you can imagine. But in a post-pandemic world, you'd like to think that they're going to get back on their feet. Now, maybe there's not the same kind of business travel, at least immediately and potentially forever. I know people say that as well. But how do you think about that relative to where their stock trades today?
Yeah, I think that this is no less an exercise in one's convictions, to be honest. Just like we talked about, parsing those who have a lasting advantage versus those who don't. When we look on the value side of things, I would divide it into two buckets as well. Those who we know what their business model is going to look like next year, and those where we just don't. And so when you talk about the airlines, when you talk about cruises, when you talk about other areas of hospitality, some of those business models, we just don't know what they're going to look like in 2021. They don't know what they're going to look like in 2021, as evidenced by lack of guidance, as evidenced by the CEOs just saying that to us. And so there is value with more predictable. Go ahead.
Greg, yeah, this is worrisome, Sorkin, and Greg, this dividend-rich stocks trail market despite high yields, and it's just a fact. And I understand momentum, and I understand, you jump on board FANG and tech and stay at home and all that stuff. But unless you think that these 3%, 4%, 5% yielders, unless you think that the dividends aren't safe, it would seem like a decent place for the less volatile part of your portfolio if you didn't want to be just totally in tech or totally in sort of momentum stocks. And the only reason you wouldn't is either you think rates are going to go up quickly, maybe you do, maybe you don't, or that the second wave or something causes a weaker economy, which makes the dividends not safe. What do you think? Why aren't these dividend stocks doing better, Greg?
So I think that that's been part of value just underperforming altogether, Joe, to be honest. The dividend-producing stocks weren't necessarily well-positioned to deliver us the growth in 2020 in our work-from-home and stay-at-home environments. But I think you're right that a lot of that value is poised for a significant rebound in 2021. And not only can you have just a healthy dividend, but you can get that in combination with triple-digit earnings growth, with a discount to historical multiples, if you parse carefully. And so some of the sectors where you can get all three of those things would be financials. There's some sectors in consumer discretionary where you can get all three of those things. Let's look at the casinos. Those that are levered to Asia have already started to evidence a pretty healthy rebound, and we're expecting in 2021 that they'll go from a negative to over $3 a share in profit, as well as $3 a share in dividend in a couple of cases. So the exercise is much the same. Look for the value, look for the earnings growth in 2021, and in many cases you'll get the dividend in addition.
Can I just point out one other potential idea with that, though? Look, dividends could be, stocks that have heavy dividends could be under pressure because of the idea that if Biden wins election and if he can get things through the Senate, that the tax on dividends could go up pretty significantly next year, too.
Right, and I don't want to discount that, but that then gets us into the argument of how much has the market already anticipated a Biden victory, and if that's the case, I think that we've done a lot of the rationalization of not only a higher dividend tax rate, but a higher corporate tax rate in general.
Greg, we appreciate you joining us as always. Always look forward to these conversations and look forward to the next one as well. Thanks.
Always a pleasure. Thanks, guys.
You bet. Bex?
Still to come this morning. Thanks, Andrew. Still to come this morning, invest in you. Some surprising statistics on how many Americans don't have a will and why having one is more important than ever.